Welcome to part 2 of lecture 3B. Okay, so we've just gone through all three of the remaining of the last three adjusting entries, types of adjusting entries. We've got some examples that you can play with here using this stuff on page 11 of the notes here. So going from the transaction information to recording the journal entry to posting it into the appropriate T account. Okay, so remember again why we do these adjusting entries. We're doing them to ensure that our accounts reflect the correct balances so that we can produce financial statements. And one of the tools that accountants use to do that is what we call the preparation of an adjusted trial balance. So imagine, let's see, let's do this. So up until now, you are used to seeing this information in a trial balance, right? And then, having done these adjusting entries, what we can do is post the adjustments into some new columns here, right? And so in so doing, what we're going to do is we're going to post the adjustments here and then come up with the final adjusted trial balance that will reflect the correct balances in the accounts, and based on them we will then be able to produce balance sheet, statement of owner's equity, and income statement. Okay, so up until now you guys have seen this trial balance in the left hand column. You've been able to recognize and journalize adjustments and adjusting entries. We're now going to stick those adjusting entries into these two middle adjustment columns, one for debit, one for credit, and then based on those we'll be able to create the final adjusted trial balance from which we will make our financial statements. So how do we go about doing that? Well, it's pretty straightforward, and once we've done we'll do an example of the adjusted trial balance in a second. But once we've done that, we create the financial statements, and of course we've beat this to death already, but every financial statement begins with the name of the entity, the title of the statement, the date or time period covered by the statement, balance sheet as at X date, and income statement, statement of owner's equity for the blank month, year, quarter, whatever ended, whatever the appropriate date is. Okay. Now, do need to also kind of go over again that the income statement is done first, right? So the net income from the income statement feeds into the statement of owner's equity, which feeds into the balance sheet, right? So that's why we do them in that order. Income statement, statement of owner's equity, and then the balance sheet. Now, accrual accounting does leave some room for some bad accountants to do naughty things, right? Because we don't have, in the case of accruals and so on, we don't have the actual dollar value of a transaction in black and white as shown in the bank account, right? So someone pays us with a check, we have the exact dollar amount that we receive. If we record accrued expenses, when we buy something, we know how much it cost us to buy it because we see that amount coming out of the bank account, right? But with accruals, sometimes they're estimates. You don't know exactly how much they are. You know that it's going to be approximately X dollars, but you don't know for sure. That allows you to potentially misrepresent information. Now, there's a difference between making an honest mistake. You buy a building and you think it's going to last for 20 years. So you take 1/20th of that building and amortize it every year, 1/20th per year. If it only happens to last 10 years because it was a lousy, construction job, then you've taken too little amortization expense over the life of the building and you're stuck now. So you will have underreported the expense associated with the building. And if you underreport expense, then you are over-reporting net income, which might make someone buy your business for a higher price than they should have, right? So if it's an honest mistake, oh well. But sometimes you can actually make, or you can come across situations where dishonest accountants or dishonest business owners make deliberate take deliberate actions to do things like understating expenses. So how do you guard against that as potential business owners? Try to make sure you get honest accountants, and most of them are, and ensure that you have enough knowledge to be able to kind of question what's going on and clearly understand the answer that you get fed. Okay, so a quick review of the financial statements. Again, net income from the income statement goes into statement of owner's equity. The ending statement of owner's equity, the ending capital balance of which goes into the owner's equity section of the balance sheet. Okay, and you need to make sure that you can do all of these, obviously for the upcoming exam and for the rest of your, business owner careers. Okay, scissors hairstylist. Our little example on how to create the adjusted trial balance. All right, so we have some information here. We have the trial balance, blank columns, and some data. Okay, so what do we have? Supplies remaining on hand, $200 for A. Okay, that's nice. So what does that mean? Well, we go and we look. Our accounting system shows that the supplies balance is $800. We know that we need to reduce it down to $200, right? And so to do that, we're going to have a journal entry. We're going to debit supplies expense for $600, and we're going to credit supplies for $600. And that will lower our balance here. So the actual adjusting entry, we can take this entry here and stick it in these adjusting columns. So supplies expense, debit $600. Supplies expense, $600 debit. And I'm going to just denote that by the letter A. And into the office supplies account itself up here, we're going to credit that $600. Okay, next we've got to record $1,100 worth of amortization. Well, we're going to debit amortization expense, $1,100, and we're going to credit accumulated amortization dash equipment for $1,100. And so we can record that as a debit to, where is it, amortization expense, $1,100, and that's B. And accumulated amortization equipment credit, $1,100, B. And then lastly, accrued interest expense, $400. So we're going to debit interest expense, $400, and we're going to credit, remember, accrued interest expense, we've borrowed money, we've sort of incurred this expense, we haven't paid it yet because it's accrual, the cash comes later, so we're going to record a credit to a liability called interest payable, $400. And there it is there, interest payable. So we're going to debit interest expense, $400, and we're going to credit interest payable, $400. Okay, so we can add all of this up, and we get $2,100 there, $2,100 there worth of adjustments. And now we're going to go across, and we're going to come up with our final trial balance numbers, the adjusted trial balance numbers. Okay, so cash. Cash is never adjusted, so it's always going to be, or it's going to be unchanged in this case, $600. Supplies, $200. Equipment, $16,200, no change. Accumulated amortization equipment. Original balance, credit $1,100. We're crediting that again, $1,100, so we are now going to end up with a credit balance of $2,200. Accounts payable, credit $500, no change. Interest payable, $400, 0, plus $400. Note payable, credit $2,900. Suzanne Bird Capital, credit $5,300. Service revenue, no change, credit $13,000. Rent expense, no change, debit, $4,800. Supplies expense, now we have $600. Amortization expense, $1,100. Interest expense, $400. And we can, that was $1,100. And we can now total our columns. Ah, crap. 400 debit plus 400 is 800. Add them all up, and we end up with 24,300 and 24,300. Remember again the purpose of a trial balance, to make sure that our debits equal our credits. Okay? So that then is the adjusted trial balance. We can then use this to prepare the income statement as requested. So everything below that line belongs on the income statement. And on the next page, it's going to ask us to calculate the balance of total assets. So that and that. So refer to the data above, compute the net income. Now, again, little exam writing hint. If it says compute net income, it does not say prepare an income statement. So you don't have to do all the fancy headings and dates and all that other crap, right? You just start out with revenue, $13,000. And then for expenses we had rent, and that was $4,800. And then we had supplies, and that was $600. And then we had amortization and interest at $1,100 and $800. So amortization, interest, 800. Add them all up, and we end up with 7,300. So finally, net income, do the math, $5,700. Okay. Next question. Refer to the data above. Compute total assets. Okay, so our list, we had cash, and then we had supplies, and then we had equipment, and then we had accumulated amortization dash equipment. And so going back to get our balances here, cash 600, supplies 200, equipment 16,200, accumulated amortization 2,200. Okay. So cash was 600, supplies 200, equipment 16,200. Accumulated amortization we said was 2,200. So the net amount for equipment 14,000, and therefore total assets of $14,800. Okay, so in this lecture we have looked at adjusting entries, the final three, so you now know all five. We have prepared the adjusted trial balance, and from that we have prepared financial statements. So in Chapter 4 we're going to look at something called closing entries, and we're going to finish off the accounting cycle. All right? But make sure you do all the associated homework with Lecture 3B, and this concludes the lecture.